All right, hello and welcome to the yet another value podcast. I'm your host, Andrew Walker, and with me today, I'm happy to have my friend Thomas Braziel. Thomas is the El Presidente of 507 Capital. Thomas, how's it going?
Good, Andrew. How are you, man? It's been too long.
I'm doing good. I'm doing great because you and I were just talking and laughing for 5 minutes before this podcast started. But let me start this podcast the way I do every podcast. First, a disclaimer, nothing on this podcast is investing advice. And I've mentioned this a couple times recently, but that's particularly relevant for the stock we're going to talk about today. You know, there are some real red flags on it. I think the upside is really interesting. It's an interesting story, but this is a micro cap. We'll probably talk about the warrants, which warrants are particularly risky. Microcaps are risky. You can look at my notes in the show links to see some of the red flags I identified here. So just everybody remember, please do your own research. Nothing on here is investing advice. And then the second way I started every podcast is with a pitch for you, my guest. You know, I've known Thomas for years. He's one of the sharpest investors I know. He's got a real eye for quirky microcaps and distressed investment opportunities. He's done some crazy stuff with bankruptcy. I mean, you can Google, it was Ethenex. Ethenex was the company.
Yeah, how did we meet? I think Ethenex. And did you just refer to them as microcraps? That's you should coin that.
I said microcaps, but I might steal that from you and steal microcaps. Yeah, his Ethenex trade. You know what? I'm just going to give some background, and Thomas, you can tell me if I'm wrong. You went to a former director of this company. The company was bankrupt. The shares were trading for a penny, and you went and said, "I'll buy all your shares for a penny." And he said, "Son, I can't sell you that stock. That's worthless. You're going to come back and sue me." And you signed a big boy letter that said, "I'm buying this."
No big boy letter.
No big boy letter.
He was the chairman of the board. He had it in a safety deposit box. He didn't think it was worth anything, and he said, "Look, I don't think this is worth anything. If you're serious, send me a cashier's check. I'll sign this thing over to you, and I wish you the best of luck." And I wasn't 1 penny. I paid 4 cents for it. I probably could have gotten it cheaper. I think I offered him 3. He wanted 5. We settled on 4. And then we got 92.5 cents out of the estate. So that was like a $22,000 purchase. And I guess I made like 23 times my money. But of course I was broke. So, you know, I kept telling people this story and how great it was going to be. And I think everybody around, not everybody, but a lot of like my wife, who was like, "Is this for real? Is this you keep talking about this?" It's been, because, you know, you think, 2.5 years isn't a long time because that's how long the investment took. But, you know, when you're broke, 2.5 years is a long time.
Yep. I think you were at Columbia at the time, right?
So yeah, I was a student.
Yeah, I'm sure it was. Hey, a lot of people say, "Oh, my student loans went to drinking or something." It was Thomas's student loans went to buying this bankrupt company and praying to God.
Fortunate. Yep. I was fortunate. I didn't have any student loans. Go ahead.
So, but anyway, Thomas is a super sharp investor, but I just want everyone to remember, you know, this is a man who will go buy securities that the chairman of the board thinks is worthless. So if he's right big, but everybody's just got to remember that risk. Nothing in investment advice. That out the way, let's turn to the stock we're going to talk about. I only know it by the ticker. It's GOED. GoodRx is the company. I think it's technically 1847 Holdings or something is technically the company name, but GOED, GoodRx. I'll turn it over to you, Thomas. Why is GOED or good? Why is it such a good idea?
Yeah, GOED. Why is GOED such a good idea? I don't know, man. I am sort of a more of a believer in setups than I am about, you know, trying to prognosticate about, you know, or I should say going super deep on, you know, whether I can ascertain if this company is really gonna perform. Now, I understand people that do work around competitive advantages and, you know, 4 to 5 forces and thinking about like why this is a great flywheel, like a Carvana or whatever. And I don't know a lot about Carvana, so I'm using this example, and maybe I shouldn't, because maybe some people would poke holes at their business models. But sometimes companies are just in the right place at the right time, and you can get a security like a warrant that's particularly levered to that. And, you know, warrants aren't like, you know, options. I mean, options suck because they, you know, you have like a mismatch between the thesis and the expiration. And so I suppose you could roll them, but, you know, I don't think that really works. Like the implied vol that you'd be paying is pretty astronomical. And so even the problem with options, even though they can be great if you have a real thesis with a catalyst that's within the window, is usually the time or the thesis duration is longer than the actual liability. And I was actually talking with Bill Brewster about this, and we we're talking about, he thinks a lot of investment mistakes are basically around asset liability mismatch. And I think he's right, maybe in some sense, which is, the thesis doesn't match, your own time horizon. Like you're thinking about, how my portfolio forming on 3 months, and everything in your portfolio has a 5-year thesis. Well, that's a great way to get not in trouble, but just to feel a lot of personal pain. So for me, I'm really more about the setup. There are a lot of red flags, I guess people point out. For myself, and we can go through them individually, but just as a high level, if someone's just joining us quickly and wants the 5-minute pitch, you have a stock that trades for 5-6 times EV, but comps in Europe trade for whatever, some triple that, double that. And then if you want to call it a e-commerce, if they can pull off e-commerce, something well north of what it's trading for. So you have a lot of sizzle in the background. And I actually really like the remodeling, housing starts, for longer sort of playbook. And I think there are a lot of guys that are putting on positions in that. And I think they'll probably all be right, whether it's, I don't know, Tile Shop, or I can't remember the one that it's either Andrew Wyden or the Sosin guy was in Home Goods. I think it was like a home, and there was some guys
that just got taken on. Yep.
Right. And then there was like, people play Tuesday morning bankruptcy and post reorg equity. Those are all probably going to do well. I just think these warrants are a particularly attractive way to play it. Maybe some people say like, hey, I want to go up market. Thomas is playing down market in a very levered way because he's in these warrants. If I size it correctly, then it should be fine. And I would, that's what my push would be for people is cheap stock, some red flags, maybe a B management team, but sometimes it's just about being in the right place at the right time, getting a good story and good valuation, and just sizing it appropriately. So if you like the story but you're not sure about it, it shouldn't necessarily. I think there's a story. I think there's like people talk about Bitcoin. You sort of have a thesis for getting off zero. So it doesn't mean it needs to be 100% of your portfolio or 50% of your portfolio or even 10%. But if it's 3% and you like the warrants, you think they're cheap, there's a story here. I think at the valuation, and I'm glad the valuations come down some, because I don't want to pitch a stock that's like, just up. I bought things very cheap. I also have issues around like, oh, how much do I trim if it goes up for tax consequences? I'm a taxpayer. And so I have to think about that as well. But I still like it. I still like it here. The stock under $4, under $6, I think is very, very interesting. And, it'll be a show me story. So I don't know. I mean, that's how I would frame it. I don't know if that's like a pitch or not.
No, that was great. I think, and I tweeted this out as I was looking at it, I was of two minds. I was like, I see what Thomas is seeing here, right? This setup is absolutely incredible. It's one of the best setups from an event situation I have ever seen. But then on the other hand, I was like, my God, the red flags. Like I was talking to our mutual friend of the podcast, Jeremy Raper, right when this came out. And and one of the things he told me when we were kind of looking at it, he was like, Thomas really built up in him, but my God, there's some hair here. But let's back up.
Because let's unpack a few of them. Go for it.
Yeah. So
back up. What were you gonna say?
I think actually a really good way to get this is the setup here, right? Like how these warrants came to be, how the deal came to be structured, because that is so instrumental to the setup here. So do you want to kind of give the history of the merger and how these warrants came out and everything?
I'll do my best, and I'll give my own personal way of how I even came across this idea, because
that'd be great.
I had a friend who was looking at this idea that works at a large hedge fund, and he said, hey, have you looked at this? It's like a, remod housing starts play. They're growing like crazy. And he said, but, I don't think what their business practices are super sustainable. This is pre, appliance connection transaction. Basically what they did when they did this deal is they took Gettekers. You said it wrong, Andrew. I'm going to correct you. Who even knows? See, that's terrible, right? Branding, people don't even know the name.
Well, I've only read the transcripts and read the filings, and this is an issue I always have. If you only read something, you never know how to pronounce it. So my wife makes fun of me because I read a lot and I mispronounce everything. When Chris and I did the podcast, I always say Yahoo, and apparently that's not how you say it. And hammer me for that. So, but please continue.
I know you say the Bitcoin. I've heard you on the pod saying the Bitcoin. No, I'm joking.
No, I say Bitcoin. Come on, I'm crypto friendly.
I'm just messing with you. But they took two businesses and sort of smashed them together to potentially create the largest e-commerce appliance, direct to D2C, direct to consumer company. And so what you want to are in the States. And so how did the transaction come out? So a friend of mine was looking at it. He said, I looked at the company. This is pre that they actually priced the deal. And I was like, dude, no offense. Like, this company is shaky. I mean, they've got a really shaky balance sheet. They just did an offering basically to stay afloat. You don't see it because it looks like they're holding a lot of cash, but a lot of the cash is restricted. That if you read the notes, it shows that they're being held back by the credit card companies. And I mean, I only know this because of the distress deal we did about 6 months ago. Those credit card companies, when they start holding back chargebacks, like credit card runs, it's a house of pain because they can really strangle your liquidity. So the company was in incredibly bad liquidity shape, and I think, frankly, this is real speculation, but I think that they could have ended up filing if they didn't get the deal done, filing for bankruptcy, I should say. So that was the lens with which I was approached this. And I was like, I don't think they're going to get this deal done because I'm talking to the bankers, and I don't know if they're going to be able to get it done at the price they're talking about or what the company's stock trades at.
Can I just back you
go
up
ahead.
1 second? So the deal Thomas is referring to is I think it was in November of 2020. Goedeckers,
right.
which it's a 35 million market cap company or something at the time, announces a $200 million acquisition with Appliance Connections, AC, I think you referred to them as, which is a competitor online appliance retailer. And they announced the deal. And I think when they announced the deal, it was about 40 million of the 200 million they owned. They were going to pay the AC owners in stock, but the other 160 million they were going to pay in cash, and they did not have financing committed. So from
Right.
November until where Thomas is leading up to, until this stock deal is announced in May or something, there's this huge overhang on this $30 million company. Hey, how are you guys going to raise $160 million of cash? So just to make sure everybody's got the overhang, I'll flip it over to you.
Yeah, and it's interesting to bring that. So that's how I approached it, because I was like, hey, I don't think they're going to be like this deal done. I was saying this to my friend. I said, but we do all credit and stress credit. Like, I'll call the company up and see if we can help them out and be a little catalyst, because I like the idea of these two companies combining it. I mean, especially if Appliance Connection is such a jewel of a business, which is what my friend who is actually quite deep in this space, whether it comes to like the manufacturers, and I even told him, I said, like, you should really go on the pod and like pitch this company. And he was like, there's no way, like, my boss would not allow that kind of thing.
It's such a friendly podcast, though. I can't believe this.
It's what it is. It's old world versus new world, sort of like,
like,
so and they're a big successful hedge fund, so they don't need to, well, I shouldn't say they don't need, but you know what I mean? I can see where there'd be like, no, this is for our clients. Anyway, so I tried to reach out to the company about financing. They said, everything's fine. We're going to be able to do it. And I was like, all right, fine. So then I try to call the bankers and see if I could get in on the deal. Cause I'm like, hey, if they can actually pull this off and the valuation's good, I'll try to do it. So Think Equity, or the guys that did the deal. And so I called them up and tried to get on their list. And I not really do these things very often. I'm really just focused around bankruptcies and distress. And I do the special stuff on the side with my own personal money. And so I called the banker, they told me how the deal works or whatever. I don't understand how the pricing works. I mean, the pricing literally is so dynamic. They price it all the way up to like the last minute. And when I saw the pricing come across the bow, I was like, well, that is incredibly dilutive, and I feel really bad for the pre-deal shareholders, but can I curse? Holy moly, this is like amazing. Like, look at where the stock price is, and look at where the warrants are. Like, the warrants are trading for 40 cents out of the box. And so I went a little crazy and bought a lot of them. So I bought a lot at 40, and I actually bought stock and warrants. What were you going to ask? Go for it.
No, I was just going to add. So what Thomas is referring to is, the day before, and I've got a quote somewhere out here, the day before the stock is at 6 or 7 in May, the day before they announced, and they announced, hey, we're a $40 million company. We're going to finance this deal with $160 million of a stock offering, and our stock's at 6. The stock offering is 1 unit. The unit is struck at 225, and a unit consists of 1 share of stock at 225 and a warrant to buy the stock at 225. It is a mind-boggling, price deal. It's just absolutely crazy. And that's what attracts you to it.
I've never seen that.
Scooping up the warrants, scooping up the stock. Yeah.
So I didn't actually think about it. At first I was buying both stock and warrants. And then like the next day I was like, sell all the stock, just buy all the warrants. I want every single warrant you can buy. And my broker was like, we're moving the price. I was like, it doesn't matter, just buy it. I was like really on I was like, it doesn't matter, just buy everything you can, because that's the implied vol was incredibly low, and the valuation I thought was very low. And I feel like I've had a bunch of these in my career. I feel like, and I'm sure you have as well, Andrew, which is like, it's almost just like moving fast on them. So that was the original trade for myself. And then, as you start digesting some of the, I don't know, sort of red flags, I guess you want to say, or issues potentially longer term around the company, I think some of them are real. I think most of them are manageable, or I should say manageable, fixable. So some things are fixable, some things aren't. Fill rates, customer reviews, better branding, C-suite issues, all fixable. And actually, I think they're in a real sweet spot between, the Lowe's, Home Depot sort of folks, which really want to move a lot of volume, and really turn inventory, and yet like the higher end brands don't really just want to sell to big boxes who are going to totally squeeze them on margin, and the mom and pops, which maybe they offer good service. I don't know. I bet the service is all over the shop when it comes to those mom and pop shops, and they clearly don't have a lot of scale, and with even Delta variant, but just in general where the market's moving, people are becoming more and more comfortable buying things online. And so I like all the tailwinds on the business, and
So
that.
I want to dive in there, but I want to make sure
Yeah.
I think we covered the situation in the event that initially attracted you to it. And, it's still out there, right? The warrants are, as I look, the stock's probably 260 and the warrants are $1.20. They're almost 5-year warrants at this point to buy the stock at 225. So you're not paying a huge vol or anything for these warrants, though I'll remind everyone everything's risky. But have we covered the event here, or can I ask you some of the kind of business questions that were lingering on my mind?
Ask me business questions. I don't know. They're another event. I don't know about another.
No, I was just making sure it would cover it correctly. So what you said there was interesting to me, right? Like the company had a quote on their call where they said, hey, we've got all the products. We can source things that Amazon, Wayfair, Lowe's, Home Depot, these big box stores have trouble doing. And I heard that and I was like, really? This little $200 million company post-merger can source products that Amazon can't do? And they said another thing. They said, our distribution strategy is Amazon and Wayfair aren't set up to distribute appliances, but our distribution strategy, which right now they have 2 distribution centers, one in St. Louis, one in Trenton, New Jersey. They said our distribution is much better there. And both of those struck me as really strange. I was like, I'm pretty sure, like, I get the luxury brands might want to protect a little bit. You're not going to find Nike in a Walmart or something, but it was just strange to me that they said, we've got all these scale advantages over some of the biggest companies the world has ever seen. So what would you say to that?
I think heavy load logistics are a real thing. Like, it's not just, when you start, adding, real weight, and I'm not even talking about computers. Even if you buy an Apple computer, it's still only, a third, a quarter of what an appliance is going to weigh. Is a real skill. You can't just drop ship it in the same way that you can with like Amazon logistics and things like that. I also think they're probably, every company pitches itself as as like, oh, you need competitive advantages and blah blah blah. I think this market is, in my mind, big enough to matter for a stock of 200 million, 300 million, but small enough to not really matter for, like, Amazon's like, yeah, sure, we'd love to sell appliances, but like, if we can't get the big brands to work with us, we want to create our own brands. And I think the jig is up on Amazon, sort of like trying to partner with like niche brands, like, I don't know, like there was that whole Amazon series on CNBC where like the guys that sold like niche paintball equipment, like had, them just like come in basically then, and like within 2 years, like mimic their product and things like that. And so I think the jig is up on some of that.
There was a really cool one. I can't remember the brand, but it was a fanny pack or backpack. I think it was a fanny pack, where they had designed this thing perfectly, right? They put great materials into it. They spent a lot of time thinking the fanny pack, like all these little nooks and things that you don't really think about, but kind of like Apple, right? Where not only does it just work, but there's all these things in there that you didn't know, like maybe a special pocket for your cell phone or that type of thing. And then Amazon came
a built-in eyeglass chamois.
Hey, that's what you need. But Amazon came and launched one, and the company put out this great advertisement that was like, you can go buy the Amazon one for $5 less, but they're not using environmentally friendly things. And they showed how shabby the Amazon stuff was. They're like, and Amazon basically ripped us off. And it was a really good mockumentary. But okay, let me turn to my next question. I think that was a nice description of the review. The biggest worry I think I have here is the AC appliance guys are coming in, and it is undoubtable to me AC was a better business than Goedecker's. How did you pronounce it?
I want to. It's Goose Deckers. No, I'm gonna feed you fake names. No, it's Goedecker's. They're gonna rebrand, but go ahead.
It's undoubted to me that AC was a better business than them, right? Their margins were better. Their fill rates were better. Like everything said they were better. They were a much bigger company. And I believe AC's owner has come over as the president, but he is not the CEO. Maybe he's driving the decisions. I don't know. The Goedecker CEO was really driving all the conversation. But my question is, A, why was he not, the CEO? Why was AC not the company to buy Goedecker's instead of the other way around? And B, he took out about 160 million in cash as part of this deal. And yes, he got, stock that's probably worth 10 or 15 million at current prices and stuff. And yes, he's on the board and he's the president, but he took out 160 million and his stocks were, a fraction of that. So I look at that and I say, he didn't get the top job. He got a lot of cash. Isn't this guy, is he on a beach somewhere? Like, is he really committed to this?
I think I saw him at the beach today. No, I mean, look, I think it's a fair question. I think two thoughts. And I don't mean to, because I think all these concerns are legitimate. So I don't want people to think like, because I never really dig my heels in on a position. Like I'm someone who's very like, oh, I don't know. Like when I add it all up, I still like it, but I appreciate. So like, I think long-term, the competitive advantages issue, I think is what you're bringing up. I think in the shorter term, there's an opening, some open field for them to run to. Longer term, yes, there are legitimate concerns around like competitive advantage. And I assume your margins and things like that. On this question, I have seen so many people with a domain experience sell out for cash because they're like, oh my God, this buyer is insane. Can you believe they're paying me X dollars for this business? And then the next 5 or 10 years of that business, the business 10X. And I mean, you could think of any family business where they basically sold out to a private equity firm. And I've just seen it a ton to the point where I try not to think too much into it, because if that guy started from 0 or started from 5 million and made 150 million, like maybe it even makes sense for him to sell, like just for his own personal portfolio. I mean, who was saying, I was maybe someone on your pod, or maybe it was Bill Bruce or someone. No, it was someone else I was talking to, and he was saying like, if you make 40 million on a trade, like you need to sell that no matter what. And I was like, I don't know about that, but I can understand where he's coming from, because it's like, really, I have to get rich once. So if this guy is of that mind, then good on him. And I've seen, like, I remember seeing, you probably follow Ethenex, am I saying it right? Which is the big data center. Have you ever heard the founder talk about why he sold out? Like, it's pretty amazing.
I think I read there's a book that covered Equinix a lot, but I read it a couple years ago. I can't remember it.
Oh man, well, send me the title of the book. I want to read it. But it was quite interesting because he basically sold out because he was like, oh, we used to make like 50% returns on invested capital and things like that. Or he didn't say that, but he's like, the payback was like 2 months. And so when these guys showed up, like the returns were all gone. It was like, yeah, but you kind of missed the point. Like the whole thing was maturing. There was no debt. Like there was going to be continuous sort of growth in the area. So I've just seen a lot of that. I try not to, people sell for a million reasons and you buy for one. So I try not to read too much into it, but I think it's definitely like I wouldn't say that, to me, that's not a red flag. It's like a yellow flag. It's like, okay, like this guy sold out, why is Doug in the seat and not Albert? I mean, because he raised the money and he was on the team that bought the company. And why did they sell to the public company? Because probably they wanted it helps them monetize. And there's no way you could raise that kind of money for a business. I mean, I don't think so. There's no way you can raise this sort of money in the private market. That's what's great about the public markets. I mean, that's why
I didn't think they could raise it in the public markets.
I mean, no, wow.
I agree with you. That's more of a yellow flag to me. That's more like, hey, does the seller, is he really invested here and stuff? So I agree with you. That's yellow flag. Let me go to a red flag. This red flag. As we said, this is a fish swallows the whale type transaction. They bought somebody who was probably 5x bigger than them. And right as they do it, a year or a month or two after they announce the deal, they switch auditors. And then 2 months later, they put out you can't rely on our financial statements 8K. And I can't remember what the reasons for not relying on, but saying, hey, we're going to do this massive deal. We don't have committed financing, but we'll figure it out. And then firing the auditor and then saying can't rely on financial statements. That's just red flags up in the air. Yeah, pre-deal. Yep.
Yeah. So I don't want to disparage anybody. So I'm just going to keep it really, I mean, just anyone can go back and look at the history of the company and things like that. And I think that to say there's no hair and that's real hair would be a misstatement. So I would say that, there's shades of gray in here, and it doesn't bother me if at the end of the day, like something is not as material. Maybe it was material pre-deal. Maybe it was material before, they owned Appliance Connection. And, maybe some of the guys who are involved in this company pre-deal aren't the savoriest of people that you want to be doing deals with, or don't have the best track record. But for me, I've missed a ton of deals being a little too caught up in things that are, I don't want to dismiss it. Again, it's like, this isn't the real thing you're bringing up, but things that are not the top 3 to 5 things that I'm worried about for this investment. I remember I passed on WWE because Vince McMahon made $14 million. And I was like, I can't own a stock where Vince McMahon makes $14 million a year. I mean, this is insane. I know Vince McMahon. I mean, I don't know him, but I grew up, watching wrestling and crap like that. And that's and also if you look at the proxy, I mean, it's just like the corporate jet usage for Vince and his wife or whatever, you're just like, oh my God, it's insane.
It's an empire. It's a real empire, but
it's Vince an empire.
I mean, look at what Vince built. That is I love the WWE.
Oh no, I should have, holier than thou. I don't need to be so holier than thou.
No. It's, but I guess what I was saying is Vince built an empire, culturally relevant. It's sustained for 40 years. Geodeckers or whatever it is.
Oh yeah, no. I'm not saying that. I'm saying there are things that I've come across that, I say, hey, that's a red flag, and I think that is a red flag. I just don't think that it's relevant now, and I don't think it's important to the outcome of whether the stock's going to go up or not. I think what's going to be relevant is whether they execute, or I should say execute, and maybe that's a good way to lead into management. But whether the remod housing start continues and that they can, put out decent numbers, if not great numbers.
Let me give 2 more red flags, which admittedly are in the past. So the answer could be they're in the past, but they just came to mind. One is related to a risk you kind of did address already, but I thought it was curious. They announced this deal in November. At the time, I think it was 42 million in cash, 168 million, 42 million of equity, 168 million of cash, right? And they did not have financing for the cash. And then in December, they quietly restructured the deal to take the cash component from 168 million to 180 million. And that just strikes me as weird. And again, it comes back to the thing we talked about and you kind of addressed already, but the sellers are taking all this cash out and the company's agreeing to give them more cash when they don't even have financing. It was just very strange and kind of related. So I'll just throw it in here. In March, they raised $2 million of cash while they're still trying to figure out how to do this big deal, but they raised $2 million of cash to go buy extra inventory. And they did it at 10% interest rates plus warrant coverage. And again, it just struck me as weird, raising $2 million at 10% to buy extra inventory while at the same time you're trying to finance a 160 million deal. And they said, I believe the direct quote was, we didn't want to spend the time shopping for a better interest rate because we just wanted to do this and get it behind us, but we'll do better in the future. It all was just adding up to more and more red flags, and red flags kind of compound on each other when you see them. So I'll flip it over to you.
Okay. So I would say that, again, it's a similar answer, not about it being in the past so much as pre-deal. There are definitely some red flags to consider, and even around the deal. I would say in terms of the cash component being increased, I'm sure that the seller was like, hey, this is taking longer than you said it was going to take, and we're like gangbusters over here growing, and we're thinking of considering what our clauses to walk are. So I don't know. To me, it just happens all the time with deals. A company's dying or a company's growing and somebody wants more money. And ways of dealing with that are, of course, maybe paying more cash, or in the instance of the rebate, giving the rebate to the seller as a way of basically giving them more cash without recutting the deal. So it doesn't surprise me. And you didn't really ask this question, but maybe we're gonna ask it later, because to me that was the biggest red flag that I spent a lot of time on, was whether these rebates were real or not. And all the due diligence I've done talking to people in the channel is, yeah, I mean, these are actually quite standard. And sorry,
why don't you describe the rebates, just so people who haven't kind of dug through the financial statements, everything know what you're talking about?
Yeah, I mean, so when you buy, a bunch of appliances, like sort of wholesale to sell retail, you're normally given like a big rebate by the manufacturer. And a lot of times that like constitutes an enormous part of your profit, so, and so the question I think people have raised, legitimate question, red flag in my mind, is whether these rebates, because they sort of disappeared, like with Appliance Connection, whether they were real or not, like whether these were really their margins pre-deal. And that was a big one for me, because I was like, because that's not right. I mean, this business is like, what are you buying? Like, the jewel isn't a jewel. So I did a bunch of due diligence around that question, and spoke to people at big manufacturers like the Whirlpools of the world, and they explained the transactions, and that these rebates are quite standard, and that they're not, they don't know anything about GOED and Appliance Connections transaction, but that these are quite standard, and it's not weird for them to be built up on a balance sheet. And or anyway, so go ahead. I feel like you're asking a question.
Can you tell me if I'm wrong? Because my understanding, and I was very impressed, because a lot of people, I posted my notes and prep for this transaction. I was impressed because there were lots of questions on the rebates, which indicated people were really digging into financials and paying a lot of attention. So good on them. I love to see that type of work, but I was a little surprised because I'm with you. It's not like I'm an operator. I'm an investor, and I'm sitting here. I'm pulling an Adam Aaron. Actually, I'm still on my boxers. You can only see my top half for those on YouTube, so don't worry, we're going to be fine. But I've never done anything like this, but I thought rebates were very standard for this type of heavy equipment. I'd seen them before. And correct me if I'm wrong, but as you mentioned earlier, one of the 8Ks, like in March when the deal was kind of dragging on, they agreed, hey, as you said, probably as a price boost, AC, when we buy it, we'll leave all the rebates with you. So as you collect them, that's like a cash increase. So I thought it was kind of settled, like it was standard, and there was a reason the rebates went away. Am I misremembering anything?
No, I just think that guys understandably are like, well, you don't even know what this adjusted EBITDA number is. Like, you guys are just kind of like trusting the company's word on like what adjusted EBITDA margins can be. And so because you're projecting out like EBIT, EV/EBITDA multiples, and you don't even know what the EBITDA is. So I think because the rebates don't come in for 3 months, 6 months, or whatever, and you need to make an assumption on when they report their numbers, they're making an assumption on how much rebates they're getting and stuff when they're presenting everything to you. And if they assumed we get a rebate of 7% on the sales, and it turns out it was 4%, and this is it's a single digit or low double digit EBITDA margin business, that crushes your EBITDA margins. Yeah, it crushes your valuation, I think. Yeah. And it's a legitimate concern. I think people worry that potentially, and I from all the due diligence I've done around Appliance Connection, it would seem that it is kind of the crown jewel of the industry. So maybe they paid up for it, or maybe they paid a real price for it, and the guy wanted cash because he's like, who knows why. Again, it's like, I think you gotta be really careful reading into why people sell things so much as like why they would buy, because again, you sell for a million reasons and buy for one. I don't want to read too much into why the guy wants cash or why the guy's selling. I think that people understandably are incredulous and sort of want proof that that these margins that Appliance Connection were sort of quote unquote achieving were real and not like smoke and mirrors. But then when you take where the margin came from and leave it in the transaction, it makes people feel like, well, hang on now, this is like a little like like sleight of hand here. You showed all these margins, but then you don't really have to have it audited or approved, because now it's been shifted back to you because as a seller. So then no one's going to look into that. I think it's a big accusation to make, but I think but I can understand why people would make it. But the diligence I've done is that these are very commonplace. And let me ask one more risk that I think is different than anyone else has asked, and then I want to ask you a little bit about execution, and then we can go anywhere else you want to go. Sure. On the call, so post AC deal, this is a $500 to $550 million revenue company, right? And the CEO has been very clear. My vision is for this to become $1 billion revenue company, and I think he's been pretty clear he's going to get there, hopefully through growth, but also he's going to acquire stuff.
And a risk in my mind, he just did his stock was at 6, 9, whatever you want to call it. And he sold the whole company at 225 warrants, common. And my
he
worry
basically
is,
gave the company. Yeah.
And somebody even kind of asked this question, and on how could you sell this much stock at this low price? And his response, I thought it was interesting, where he basically said, hey, this was all, he didn't say anything about shareholder value, right? It was kind of all about
transformative. Is that what he said?
Transformative to buzzwords. Yeah. I have the quote somewhere. I can't remember, but it was pretty much transformative. He was like, it wasn't about the price. It was about getting this deal done and growing and becoming this whole new company. But it didn't seem like shareholder value was of much concern there. So I guess my question and my risk is, and then we're going to talk about, I think the biggest risk, once you put the red flags behind you, is execution. But my question is, what's to stop him 6 months from now? AC is starting to get integrated. Things are going good. He announces another big deal, and they sell 30% of the company at $1 with warrants or something, because it just doesn't seem like he's super cared about minority investors.
I mean, I think he's an operator. He's not like a financial, wizard. He's not Warren Buffett. He's basically, his background, he ran Sears Appliance when Sears Appliance was a thing. It was like one of the largest, or if not the largest, like appliance sort of distribution companies, within Sears. And so I think he's very operating, and he thinks the future of appliances is direct to consumer. And he just doesn't think it's long overdue. It's now the time to be doing this. And I also think that, and this is speculation, and I say this in front because I really just don't want anybody at a company to ever get upset at me. But like, they had to do this deal. They were dead if they didn't do this deal. In my mind, the company was kind of engaging in potentially unsustainable business practices, hoping that they could raise equity to finance their way out and sort of grow their way out of potentially unsustainable business practices, with those low fill rates. And then the credit card company sort of putting the hammer on them meant that they had to get this deal done. It was kind of a do it or die kind of deal. And I don't see that as being a deal that they'll need to do in the future. And so it's like, again, it's back to this idea that I think, to me, the best idea is always have some red flags around them. And they have to be controversial, or they're not going to be interesting because they're not going to be cheap enough. Everybody's going to sing Kumbaya, and we're all going to buy Apple. I mean, and I don't want to like go there, but I would say that I just don't see that. I don't see that as a future deal. They had to do this deal. I mean, he was dead without it.
As you said, one of the riskiest places to invest is heavily shorted stocks. I mean, especially because they can turn into meme stocks now, but heavily shorted stocks in general, that they well underperform the market. But if you find a heavily shorted stock and the short thesis is wrong, you will make a lot of money, because heavily shorted stocks where the short thesis proves out wrong go up, and they go up screaming. Stamps.com, there was a short thesis on them at like 20, 40. They just got bought out for 300. And if you read the proxy, private equity firms were begging to buy them at 100, 120, 150 a couple of years ago. So there was a bid there the whole time. Tesla, I don't even know if the shorts were wrong in stock price, but when you look at all the shenanigans that went there, I don't know if the shorts were wrong in story.
I don't know. Yeah, who knows? That's a really wild one.
But I can tell, so I do agree with you. The controversial ones with hair is where the real money can be made, but I can tell that the company has been getting questions on leadership, because I'm looking at their deck right now, and they've got six slides.
Yeah, what was that about? I was like, what the hell is this?
And it's kind of funny because they've got six slides devoted to how aligned the board is. And the first thing is the CEO owns 30,000 shares of a stock that's trading for $2, and he makes, $1 million a year. It's like, if you think about that for 1 second, I don't know how aligned that is. Not that he can't be aligned, but yikes. Let's talk. I think the biggest risk, once we put those red flags behind, is execution, right? They've got to merge GOED and AC together. Next year, I think they'll switch the brand name to something. They'll unify the brand, as they call it. They've got to merge it. They've got to get GOED's fill rates, which is, if 100 people order a refrigerator from them, shipping a refrigerator and stuff takes time. A fill rate is at 80%. That means of the 180 orders come in. That's where GOED's is. AC was kind of 85%. GOED's margins, I think they were 22% gross margins. AC is 26. 4% of gross margin points makes a big difference, especially when you're talking about a couple $100 products every time. But, how do you see the execution playing out, the integration, all that type of stuff? Because I think that's where the next big risk is.
So I think, again, right place, right time. You don't need to be a genius to be in the right place at the right time. And sometimes it's just luck. And so I think they're in a fantastic spot. I think if they don't execute, the stock will stay where it is, and you'll have what you're seeing now, which is basically activists. I mean, I've had a few activists actually call me about the stock.
Really?
Yeah, I have.
What are they?
I've not spoken with Carlo.
We're not forming a group. Oh, I forgot Canel was here. We're not forming a group. We're not pushing activism. But
was he on your pod? Oh no, you're saying he's here, like he's in the stock.
Yeah, he has not been, but if he's listening, send me an email. I would love to, because he does some really interesting stuff, and I'd love to chat with him either on the podcast or just offline, because I think I do interesting stuff too. I don't know, but
you do.
What do you
think?
think
His book would be like, I would literally just invest in everything he does. Everything stuff is cool. But I don't know. What were you going to ask the question? Go ahead. What was the question?
What do you think the activist angle for this company would be, right? Because they just did what you think could be a killer deal. Obviously, we could talk capital allocation, might be a concern going forward, but they just did a killer deal, and it's clear what they have to do. They have to integrate, they have to execute. So what value add is an activist bringing in here?
Being in the boardroom and like watching monthly operating metrics and execution and leadership from the C-suite. And if they're not seeing that, to remove said person, whether it's a current CEO or someone in the C-suite that's not delivering, whether it's on merchandising, marketing, whatever, logistics, because that's going to be a big part of the business. All these things are important to a company. And, I mean, we're talking about a stock, we're talking about special sits, but at the end of the day, like, there's an actual business here. And so if they're not executing, I think it's important it's silly to call them activists, engage shareholders to be able to maybe be in the boardroom. I think be in the boardroom and be watching the shop and being like, hey, this is great. Like, keep going. Or like, hey, like, who's doing the marketing? Because like this is not hitting the mark. And I think board members with relevant experience in these channels, whether it's big distribution businesses or D2C businesses or appliances, I think is important. And I'm sure that's what Carlo and I can't remember the other gentleman's name who's in like autoparts.com. I did actually speak to him briefly, but his message was like, he was just like, look, I just want to see like great board members with great experience helping shepherd the company. It's not an ultimatum. We're not here to like leverage the balance sheet, put the company up for sale. It's like, this is execution. And he had a very similar, I think, sort of similar bent to me, which is like, these guys are in the right place. They have the opportunity to be a multi-billion-dollar business, but it's going to require execution. And I can't disagree with him. I'm not sure I'll be around for all that if that were to occur. I mean, I'm really a special sit guy, but he's not wrong. And I think if they don't execute, stock stays cheap, and I don't want to say the buzzards, but you attract attention from people that will, put you through boot camp. I don't know.
Let's real quickly, so right now, stock around 250. It's not a crazy complex cap structure, but there are warrants, which, as the stock goes up, the warrants dilute and everything. So it can get a little complicated, but let's just quickly talk. We're not talking super bull case where Goedekers is the next Amazon and, every appliance in the world goes through them. And also they've got web services, and they're using their distribution centers, not just to deliver furniture, but they're going to deliver me a pizza every day and everything. But let's just talk reasonable bull case. Just quickly paint me 550 million in revenue is kind of what they were targeting on the heels of this deal. What does that translate into EBITDA, and kind of give me a reasonable multiple, and what would that paint the stock at?
Ouch. Okay, that's you're
pull up
gonna,
that Excel spreadsheet, Thomas.
You're not gonna like my answers here. I think that it's achievable. Again, I'm like gonna draw like a truck through here. I think if you look at the different margin analysis, and then you look at, I'm sure there are incremental revenue and incremental profit centers they can create around a D2C and the appliance vertical. But let's just stick on this vertical. If they execute and the numbers they really are only slowing down on revenue because they can't get the fills, meaning they really want to keep their
people are so, and you can look industry wide, people are so, we're all stuck at home. I've been doing anyone who's watched the podcast on YouTube, I've done
I'm in the
65
same room.
episodes, 64 are in the same room, but we're also people are desperate for refrigerators. Nobody can get parts. Supply chains are awful. So that is not them alone. This is every company is saying it. And that's why they can't hit their fills completely. But
yeah, so I mean, if you can do 550 and you can get somewhere between, margins to put you somewhere between 40 to 60 million in EBITDA, and you've got a D2C business model, which I think that's kind of where the puck is going. I don't know why you can't get an attractive multiple on that. And I would frame it in the way I would frame it the way that like a really not a statistician, but I guess like a math person might, is like, I would say that if you're paying 250 300 million for 50 to 40 to 60 million of EBITDA, and I mean, I know that doesn't look at free cash flow, but I can't imagine that isn't somewhat close to free cash flow. I don't know why you can't and an inequality. To me, that's attractive. You're talking about creating a business for a multiple where if there's growth, the multiple should be high and you're getting a very low multiple. And sorry, go ahead.
No, so on their normalized numbers, I think what you're saying with the stock at 250, you're probably trading maybe 6 times EBITDA if you assume they can do 550 with about 10% EBITDA margins. And they had a slide which, I always raise an eyebrow when a $100 million company compares them to Amazon. But your basic thesis here is, hey, I'm paying 5 times EBITDA. Hopefully it's growing because of the tailwinds and everything we talked about. But I think this business could command in a reasonable base case 10 or 12 times. And, if things get really spicy, 15. And at that point, we're talking about a triple on the stock, and the warrants more so because the warrants are naturally levered because that's how warrants
work.
You
gotta, I don't know. I mean, like if you think about the warrants, again, like 5-year warrants, I bet it's a basket if you just bought all these kind of like warrants, not the SPAC warrants because they can be called away, but just like warrants in the market in general. I'll bet on a risk adjusted basis they do pretty well. Yeah. Just because the implied vol is low for, and so that's why I really like them. It's sort of like, I like the backup story, and there are probably other stories where you can buy things for 5-6 times, and there's tailwinds or there's a thesis there. I mean, I have a friend who's in like a steel SPAC that's like, it went off at like 2.5 times, but people are like, oh, it's the height of the market. You can't buy it 2 times. You're going to get your head blown off. And I'm like, okay, but I mean, the implied vol on the warrants, although they are callable,
I'm gonna guess the friend and the stock. The friend is Jeff Moore and the stock is Lego.
No, it's not Jeff, although I'm sure Jeff is in it or looked at it. It was Tim Bergen, who I'm sure he doesn't mind.
Oh, yeah, Tim's come on the pod. Love Tim Bergen. He does On Beyond Investing. Yeah. Great service if anybody's interested.
Yeah, I'm a subscriber. By the way, I need to subscribe to yours. I'm sorry, I'm not subscribed to yours. I mean,
That hurts.
Oh, dude, I should actually, because I'm always impressed with like you're just like idea generation. You're a dogged idea generation. Like I don't have as many ideas as you do. I can't.
Well, it's quality over quantity, right?
No, that's not true. That's not true. I'm a bit lazy. Also, I do a lot of my day job is not distracting, but it takes a lot of my time.
But one thing I've been really pushing myself, and you are one of the people who has shown me that, I mean, with your Ethenex trade and this trade from buying at the bottom, when you find something that's really in your wheelhouse and the risk adjusted is really good for you, you need to swing really gosh darn hard. And I think one of the things that has hurt me as an investor, and I'm trying to get better at it, I'm always trying to improve every day, is I've had some stuff that have been right in my wheelhouse and I have not swung hard enough at them. And it's easy to say that in hindsight when they've gone up a ton or something, but looking back on it, even at the time, like there's one company, I'll go ahead and say it, WOW, which is a cable overbuilder. And anybody who's followed me knows I've done tons of work on cable. And last year it was at $4 per share. And I even put a note, I'll make a pitch for my premium service though, please. I never want anybody to feel like they need to subscribe or anything. I put out a note that said, WOW stock starts with a 4. I believe based on asset value, precedent transactions, everything I've done, it should start with a 4. It should just have an extra digit in it. And the stock in a year has gone from 4 to 20. They sold some assets. It's done great. But when I look at that note and I think how much time I spent on the cable sector, I say to myself, how did you not swing harder at this thing, Andrew? Like, this was a perfect pitch for you, and it's to your detriment you didn't swing harder. So anyway, last thing on GOED before now that I'm done beating myself up and pitching my own service. last thing on Godeckers. We mentioned EBITDA margins. You mentioned free cash flow. And it's one thing I wanted to bring up because it's very easy as investors to just get fixated on EBITDA, but DNA is real. And I'm of two mind with Godeckers, where this is an online business. Online businesses are famously capital light, but their distribution, heavy appliances, they need to ship all those things and stuff. Distribution centers, shipping, it's not cheap. Look at how much Amazon spends every year on warehouses and stuff. So when I say EBITDA margins, like how much of that is actually going to translate into cash flow, or you can just switch it and talk about like, why is this a capital light business, that type of thing.
Oh man, these are just too hard for me to answer, dude. I would assume that they would be decently asset light, and that there really shouldn't be too much of a drag between EBITDA and free cash flow. The DNA is real, of course, and as you grow, you have to consume working capital, and so I guess that's DNA, but maybe that's like growth capex, really. But the other thing I would say is, they do. I wouldn't say they're negative working capital, but it's actually quite interesting their way, their business model. They're normally they don't require as much working capital as you think to grow, which can be a problem within companies. You think like, oh, they're growing, this is great, but when you grow, your working capital increases and you sort of are consuming cash. I don't know that I haven't really dug down or seen enough to be able to model and think about it, but I wouldn't be surprised if, I wouldn't say they have negative working capital. There's no like there's no like float, but I wouldn't say it's that far off.
Most companies that buy from, grocery stores are negative working capital. Anything that sells to consumers and buys from businesses, because you get accounts payable 30 or 60 days and consumers generally pay you up front. In general, you will be pretty, at least working capital light or negative working capital.
Hertz switched everybody to 180. Anybody owns the stock. Hertz, post reorg equity, Hertz, they switched all their suppliers to 180 days.
Do you remember, the second time we mentioned Tesla here, but Tesla, when they were really stressed, they just sent all their,
did they?
They sent all their suppliers a letter that said, hey, I know we've got contract terms, but we're going to be paying you 15 days later. And by the way, we're going to pay you 2% less than we agreed upon. Take it or leave it. And a lot of suppliers were mad, but all of them actually took it. So
I mean, I would put, I think companies can do things like that. I don't know, they're transitory, so you only do it one time. But Tesla. We will have another pod about Tesla. That's not really for your type of pod. That's like I don't know.
I'll talk Tesla with anyone who wants to talk Tesla. I find Elon Musk a fascinating character.
Me too.
You read his book. I've had a small short position on it off and on over the years. You read the Ashley Vance book on Elon Musk, and you see the stuff in there, and you're like, there's no way this guy doesn't blow up at some point. But at the same time, you've got to admire the vision, SpaceX, reusable. It's absolutely incredible. But I'm of so many minds, because you never want to use that word, a fraud, but a lot of the stuff with Solar City, a lot of the stuff with, all of it just screams.
The autonomous stuff is really I feel like that's where things are really gonna fall apart on him. Like, overselling on I'm not an expert on the stuff, but like the levels of autonomy that they've reached and things like that.
I was talking to someone yesterday. We were promised autonomous robo taxis from Tesla in 2019, and we're approaching then to 2021, and I still don't have my robo taxi. The Tesla semi trucks were supposed to come out in, I think, 2020. I haven't even seen a working prototype yet, I don't believe. So, but neither here nor there. And I actually do have a lot of respect for Tesla as a company, and I don't know a single person who's bought the car and hasn't enjoyed it. But Thomas, anything else you want to say on GOED? Anything else we kind of haven't covered that's lingering in your mind?
I mean, if somebody has a better way to play the remod housing starts play, and I know there's guys in lumber and things like that.
I was about to say, my buddy Mike Mitchell might think there's a better way to play.
I'm long that one too. I'm long that one too. I'm long, and I know people say, "Oh, it's a high cost producer," blah 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 blah. It's like, is it going to matter if lumber is at 1,500? And I'm not saying it's going there, but there's a real probability that it could. And I was able to get in cheap because of the warrant issue that was going on, or the right. I guess they're not warrants, they're rights, but the whole rights issue where people were having trouble subscribing. So I was able to scrape some up very cheaply.
I'll disclose I participated in the rights offering there, and the fact that Thomas said he was participating was one of the things that kind of spurred me to really dig into it. But that's another one, right? Like there's hair there. It is a weird structure, weird deal. The management team is a little bit controversial, but there is, as a risk adjusted play, there is a heck of a lot of upside to that deal. But everyone should remember, nothing on here is investing advice. Thomas, I've got two more things to say before we go. A, everybody can tell how much I enjoyed having you on. I'm not sure I've smiled and laughed as much in a podcast. So thank you so much for coming on. It was great having you. And B, before we started, you said, hey, an hour-long podcast? I'm not sure if we're going to be able to hit 30 minutes.
We do an hour?
How long is this podcast run, Thomas?
But I just like chatting with you, Andrew. It's been way too long, dude. Like, you know,
it really has. It really has. And, you know, we'll have to catch up a little more frequently. And I know you're trying to lure me to Italy, but my wife got me to Spain for a little bit. So I don't think I'm coming to Europe anytime soon, but you've got a place in New York. So next time you're here, we're definitely going to meet in person. But Thomas, thank you so much for coming on. Everyone remember, this was a great podcast, but this is very risky. So please do your own research, but Thomas is great. Have a good one, man.
Yeah, same to you, Andrew.